So today we're going to be talking about what Nick Timiraos, who is a writer for the Wall Street Journal, but most importantly, like an insider for Fed information, had to say regarding the latest stock market rally after the October CPI report release. If you may remember, the October CPI report said that we currently have an inflation about 7.7%, which is way better than what they had forecasted. So, Nick says, Fed Governor Christopher Wallace on the October CPI report. The market seemed to get way out in front. I just cannot stress this one data point. We've still got a lot of ways to go. Moreover, if you use a Taylor type policy rule, short-term interest rates aren't that high. We're not that tight. Real rates are barely positive a year out. If you see the interest rates, literally before March of this year, we did not have any interest rates hike. We were literally at a target rate of 0 to 0.25%. And ever since, the Fed has drastically hiked rates. For the past 4 times, we have drastically rate hikes by 75 basis points, and we are currently at a target rate of 3.75 to 4%. Moreover, Waller says the FOMC statement in November was designed to signal a potential step down to 50 basis points. We knew the markets were going to jump for joy, so the Fed used Powell's press conference to drive the point home that it's the ultimate level for rates that matter. Now, I do have to agree with Waller in the statement here. Jerome Powell was very, very clear in his Fed statement that there is still lots of pain left to go. The inflation is still too high. Like, I feel like we feel like 7.7 is normal now, but by no means is it normal now. And he talked about how the Fed wants to get to a 2% inflation. Yes, the rate hikes might not be 75 basis points, but there still will be 50 basis points, which is still very, very high and will cause a lot of pain to people. Morgan Stanley actually had a change on their inflation outlook, and they say that US CPI is currently 7.7%, but they forecast it to be under 2% by the end of next year. Wow. There are 5 reasons that will cool inflation. Global demand could be weaker. Supply chains are showing much less stress. Inventories look increasingly elevated, inviting discounting for core goods. Risk in shelter prices is much more balanced, and base effects shift materially. US gas prices are up 11%, but will be down 11% by March at current prices. Morgan Stanley's Fed projections. We think that the Fed will pause after a January rate hike at 4.65%, which is actually pretty low. A lot of what I've been reading is saying that the Fed might need to do at least 5% or maybe 6%. So this is a really, really good projection that there might not be too much pain left, at least for the Fed hikes. So I hope you enjoyed this video. I just wanted to say that there potentially is a lot of changes that need to be done by the Fed, and the pain will last longer in the market. By no means is the fight to cool down inflation done yet. So especially some people that are looking into buying value stocks, yes, this is a rally, but there's definitely a potential for more downturn, and it's a good time to kind of look into the market to see where maybe you wanted to buy a stock that you previously wanted to, you can buy it now at a way cheaper price. So I hope you enjoyed this video, and I shall see you in the next one. Bye.